Gautam Duggad, Head of Research at Motilal Oswal Securities, joins us on the show right now. Gautam, hi. Morning. Good to have you on the show. We were just digging out the data that in Q3 so far, it's been a 23% year-on-year uptick that we've seen, the best in the last 5 years. What are the sectors that have stood out for you?
Yeah, so as far as this quarter is concerned, I think the numbers look decent. It's in line kind of a quarter as far as Nifty and our broader universe is concerned. And I think if you peel off the earnings a little bit, you'll find that the quality of earnings is improved, not by a big notch, but a little bit for sure. So Nifty has grown 9% in terms of earnings, which is in line with expectations. PBT growth is 4%. But again, it's been a very narrow, it's led by BFSI and consumer this quarter and dragged by commodities like metals and oil and gas. For a moment, if I look at Nifty earnings ex BFSI, it is absolute 0% growth. And at the same time, if you look at Nifty by removing metals and oil and gas, which is commodities, then the profit growth is 23% and PBT growth is 16%. So clearly, I think commodities for last 3-4 years have been uninvestable given the significant volatility and global issues which are around. So quality of earnings in my view is good. BFSI and consumer has driven it. Cement and capital goods have been a miss. Auto again has been a miss. And if you look at tech and utilities, they've been by and large in line. The problem is 2021 earnings, right? There is a significant growth revival expected in FY21. If you go by bottoms-up estimate of our analyst, the EPS is expected to be somewhere around 680, which is a decline of 2% versus 3 months back. But it is still a 27-28% kind of a growth. And given the environment that we are in, we think that the macro is still weak. High frequency data indicators are still not showing a big revival. And therefore, the possibility of a further earnings downgrade as we move forward into FY21 is quite high. So if I were to see instead of 28-27% growth, the Nifty ends up delivering 17-18%, which still will be good on an absolute basis. But then at that EPS, the market is already trading at 20 times FY21. So therefore, from a Nifty point of view, the possibility of a significant upside is quite restricted.
Let's look at pockets where there is stress. Banks are now indicating that the NPA recovery has not bottomed out. It was Diwan housing for some banks, it could be telecom and other related sectors. If large part of the earnings are coming from the financial sector, and optically if they start doing more write-downs in coming quarters, given what's happening to telecom, real estate and other sectors, what happens to FY21 projections now? Because banks taking a write-down means the aggregate picture will suddenly start looking weak.
Yes, absolutely, Nikunj. The picture becomes quite ugly if banks were to not deliver the earnings expected for FY21. In fact, FY20 itself, the entire earnings recovery or whatever earnings growth that you're seeing in Nifty is purely because of BFSI. So for a moment, if I step aside of the quarter and look at the full year FY20 numbers, then we are expecting around 9% EPS growth. And if I look at profits by removing BFSI and Nifty, then we are at a 2% profit decline, which is the weakest in the last 4 years. The Excel sheets are suggesting that FY21 will have a slightly more broad-based earnings scenario. So FY20 BFSI contributed 120% of incremental earnings. FY21 that contribution is expected to go down to 40%, and other sectors are expected to contribute. But still at 40% incremental contribution to the growth, BFSI remains a significant part of the earnings revival story. And if, as you rightly pointed out, more skeletons come out of the cupboard, be it telecom or real estate or some other NBFC, then clearly the downside risk is quite elevated for the FY21 earnings estimates. Even if BFSI were to deliver what is expected of them, even then I think there is a significant risk to the earnings estimate for FY21, given that some of the other packs are also not firing.
It's not taking account of coronavirus and the impact it could have. Now, even the Chinese don't know what will happen to their economy. But the markets somehow are saying, look, what's happening to coronavirus is a health hazard, it's not an earnings and an economic hazard.
Yes, I mean, there are some sectors where the impact will be quite exaggerated. And as far as we are concerned, we don't know what the impact will be at this stage. and therefore it is better to be cautious. I mean, the sectors which can get impacted clearly are auto, pharmaceuticals, some of the durables which are dependent on China for component manufacturing. But it's very difficult at this point of time to quantify what the impact will be. But suffice to say that it's going to be a significant impact. If you're not going to see it in Jan-March quarter, maybe April to June, but it's a very big risk for CY20, a risk which nobody had apprehended when the year began, and a risk which has hit us right away in the month of January. So, you have to be in sectors where at the margin, relatively, you are seeing better earnings visibility, good quality balance sheet and cash flow. And I am of the view that markets will find it very tough to broad base this year because the budget is gone, most of the policy announcements are done, and we are not seeing any significant stimulus to short-term growth. The government has chosen a path of fiscal prudence, so for whatever reasons, but even if it's a sound long-term strategy, from the short-term perspective, it is not providing any fiscal stimulus to the growth. So therefore, it is difficult to believe that corporate earnings will broad base when the GDP still remains in a 5 to 5.5% band. And therefore, if corporate earnings do not broad base, the market can remain narrow for a longer period of time.
In this kind of a market, I mean, everybody has argued, and I also thought not right now, but 2 years ago, that the market should open up. This narrow concentration in 10-15 stocks is unlikely to continue. But for those who bought those stocks, I mean, there are some fund managers who right now have NTPC, ITC and State Bank of India in their portfolio. They are not feeling happy. And there are some fund managers who have,
Because you might as well take the name. Which fund manager you're talking about?
You're talking to a sell side guy, so I won't talk about the buy side problems right now. But for those fund managers who right now have HDFC, DMart, and for that matter, Bajaj Finance in their portfolio, they think there is nothing wrong in the world. So, which is the right way of doing things?
Nikunj, I believe in erring on the side of caution, and I think that till the time you don't see more evidence of earnings visibility from other sectors, it is better to stay away from them. So for example, our call for last 3.5 years now has been to stay away from metals, oil and gas, utilities, construction, real estate, capital goods, and stay more towards private banks, IT and consumer. IT, I understand, has not done that well in the last 6-12 months, but I think it still offers a significant cushion as a hedge because the cash flows are very solid and they are returning it back to the shareholders. Consumer, we are as bullish as we have been in the past. In fact, last week we upgraded the target price of Hindustan Lever. We've been very positive on the discretionary side as well. So be it a Titan or a Pidilite or a Britannia, or for that matter, some of the smaller retail companies like ABFRL and Trend. By the way, retail sector has had a very blockbuster quarter. Any company you pick, ABFRL, Trend, DMart, VMart, they've delivered very strong top line growth in a consumption slowdown environment. And private banks is the only hope as far as the broader Nifty level earnings revival is concerned. So you can take your pick, either it's corporate bank or a retail bank, but you can't escape, the BFSI space because 42% of the index is BFSI. We will reassess as we move forward. If the earnings get more broad-based, maybe we will change our portfolio allocation. But as of now, this seems to be a strategy which is working. And I think till the time we are in this 5.5% GDP growth environment, it's too risky to take a call that earnings will broad-base significantly, and therefore the portfolio should also get more broad-based.
Gautam, good to have you on the show. Thank you so much for taking the time out.